Welcome to Preserving Your Wealth with Mike McCormick, where we talk about smart ways to invest and preserve your money. Mike is a registered investment advisor with McCormick Financial Advisors in Bozeman, Montana. As an independent fiduciary, Mike does not receive commissions from any of the products or investments mentioned on this program. Consult a professional before making any investment decision. You can find old shows archived at McCormickFinancialadvisors.com. Learn, participate, interact.
And the aforementioned Mike McCormick is in the house. How you doing, man?
I'm doing fantastic. Happy Thursday.
Yeah, happy Thursday to you. Shane's on the line talking to you.
Shane, hello.
Hello, Mike. Welcome to the house. Good to hear you.
It is great to be on the morning soapbox.
Yes, it is.
Heavy on the bubbles this morning.
That's right.
Just how we like it.
Yeah. Well, as I said earlier, the big news, I guess, is Walmart and Disney so far.
You know, it's a meat and potatoes type of environment. It has been since Trump took control of this market. If you've got a name of a stock that you can't pronounce or had never heard of, it might not be as profitable as the ones that you have. And it's, USA all the way, really, is where it's going. And today we're going to see a bit of a breather now that we're hitting these new highs. There's usually a period of sort of bouncing around and being hypersensitive to news bits. But it is fascinating to watch how sentiment changes so quickly, right, Tom? I mean, it's we're going great, everything's fantastic. Oh no, we're not. Everything's horrible. Those news flows are herky jerky, and in the meantime, as we always say, unemployment's really good, inflation's non-existent, and consumers have really a ton of cash on hand comparatively. Fidelity came out with their investment report for the third quarter for retirees, and they did point a bit of caution out. They said, people are owning too much percentage of stocks. If they're within 10 years of retirement, Fidelity recommends that they don't hold more than 70% of their portfolios in stocks, which would mean that the other 30% should be in more conservative bonds, and
or gold or something like that.
Well, so you and I agree with that, but Fidelity is very meat and potatoes on that. They would say 70% stocks, 30% bonds. They're not going to go out and say, and some weird stuff on the side.
Some 2% of gold or something like that. They're not going to say that.
They're shopping on the main aisle of the supermarket right here.
Okay. They're not in the organic section.
But they're a big company, right? So their analysis is really of their own holdings. So it's interesting when these big custodians report about things like a Schwab or a Fidelity or a Vanguard. They can say what people are actually holding. And their study found that people that are older are getting too aggressive. And I don't necessarily think they can just come out and say that because they don't know what the other things that those people own are. They don't. For all they know, they could have $250,000 in CDs and they got $100,000 in a 401k. That's a different relationship. So it's one of those things that us planners focus too much on what's inside the things that we control and not enough on the whole picture, on the whole net worth, on as we always talk about real estate. I hope we get a chance to talk about real estate today.
Sure.
But it is a time to reevaluate it. We're coming to the year end. We're getting to the point of tax planning, and I should say that the one thing that I caution people this type of year, every year, is that actively managed mutual funds can kick out tax liabilities even if they haven't made any money. So a fund would be a basket of things that somebody's trading for you. They would buy low and sell high, and then they can aggregate all of that tax liability from buying low and selling high or collecting dividends or interest. And then they sort of just release it all to the owners all at once this time of year. And it can be very unsavory. If you hold mutual funds that are actively managed inside of a retirement account, you're not subject to this. This won't affect you. But if you hold them in an account where it's just your name on it, or maybe it's inside of a trust or something, these actively managed mutual funds have continued to not, on average, not outperform the passive ones, which do not do the tax damage that the active ones do. So a bit of a complicated thing, but just ask your advisor if you've got an account that you pay taxes on. If you're holding actively managed mutual funds, there's still time to sell these things before they go and they shoot you with an arrow of capital gains in a year where, they should have made money this year. Anybody worth their salt in active management made money this year, but they haven't outpaced just a good old S&P 500 for the most part.
Yeah. Well, the other thing, I think the market yesterday passed 100 records in the past 3 years, S&P as well.
Well, I'm not
100
sure.
record.
Like vinyl records or like.
Well, the top records, the height of the value.
Worth a lot of
yeah,
money.
worth a lot of money.
Worth a lot of money. Yeah.
$9 trillion in new wealth, something like that.
I didn't see that report, but yes, we make new highs all the time.
Yeah, no, that's true.
It's not news when we make new high because
it is when we make 100 in 3 years. I don't think that's ever been done before.
I'm not sure. 100 new records in 3 years.
Yeah.
Well, coming off of the decade, the Great Recession and all, and then we did have. Don't forget, we had our Christmas Eve massacre last year.
That's true.
When you least expect it, that was a curious one.
Well, we've had 10 so far this year, I think, something like that.
10 records.
Yeah. Since December.
Since December.
Yeah.
Well, you can't.
10 record close.
Okay, 10 record close. Thank you. I'm looking for clarification on that one. I don't get excited when we reach new highs because that's what's supposed to happen. Population growth,
well, it is. That's
increasing capitalism and demand. Things go up over time. They never go in a straight line, mind you. This is not a straight line game. And then, when Fidelity comes out and says, hey, people are holding too many stocks in their portfolios that are getting old. Okay.
But isn't that due to things like 401ks and IRAs or retirement funds?
Yeah, that's what they
like
manage,
that?
exactly.
Yeah.
Fidelity's got a ton of 401ks.
But, most people aren't going to go out and buy bonds. The rank and file.
Well, their point
8
is
to 5
that
worker.
Their point is that if you hold an account, you should, in your baby boomer, you should reallocate and get more conservative, which is a good move when we're when we reach 99 highs in 3 years or 10 and 20 or whatever.
Well, but the other thing you pointed out last week was that sometimes these bonds that you think you're going to get 4%, somewhere along the line they reevaluate them, and all of a sudden you're making 2% instead of the 4% you thought you were going to make.
And that's really the rub, Tom, is that they're not by making people get more conservative. In my mind, they're moving them towards greater risk in some ways right now, and not to create concern out there, but yes, the bonds are overvalued. Yes, interest rates can only go. I think they can only go up from here. I mean, we're going to get testimony from Federal Chairman Jay Powell today, and he's already came out in statements that said that his neutral rate is above where we are today for interest rates. And so it's going to have to take really bad news for him to cut again, although there's a 50% chance, according to the surveys, that there's going to be a cut next June.
Yeah. I was going to say, I think he mentioned yesterday, I don't think we're going to see a December cut.
Nobody thinks we're going to see a December cut.
Yeah.
Which, when he came out and said that, the markets didn't throw a tantrum, which is a good sign. It's a good sign when people are, all agree, okay, don't need another cut. But right, as the election season kicks off, as the discussion about, I do think that we're going to see a lot of Democrats claiming that the deficit is unsustainable, which is, opposite day, right?
You think they are? You think
I think it's an obvious
I don't
thing.
I don't hear anything about it so far.
I think that it's one of those things that they can point to in numbers that does strike a chord with some people.
Yeah,
right?
could be.
That's
Shane, any thoughts on the market and bonds and all of that?
Sure. 3 thoughts. First thought, your debt went over $23 trillion yesterday. Nobody mentioned it, especially the people on the campaign trail that want to increase it by another 20 to 50 trillion. Number 2, Disney. We told you about this a year ago, and here we are. 0.2 to 10 million signed up first day, crashed their site. So my prediction at that rate, probably right, they'll have 100 million by Christmas, and I say 200 million by June of next year. That'll surpass Netflix. It's got 154 million worldwide, 148 million paying, 60 million in North America. Watch Disney, folks. This is going to be wonderful, and it should make you aware that the network values are going to have to go the same way. So look at, you've got to talk to people like Mike. Do you hold a cable company? Do you hold a network stock? Because they look like buggy whip companies to me, right, Tom?
That's right.
And with Wi-Fi being posted across your country, they're at 20 million on heading from the East Coast to the West. They put up 20 million already, and they're going to 64 million. So once Wi-Fi is across your country, streaming will be the service across North America.
Yeah.
And finally, the great thing that we should be aware of, what you're saying, I think, with Fidelity, is that there's such a large number of baby boomers retiring, as we're now at 18,000 till 225. There's a need for people to be aware of, maybe be secure too, to be just in cash. It doesn't necessarily mean buy bonds, but you may want to go to cash, because if this market corrects, which it could, we all anticipate some type of correction. You're better to sell now and not cry later. Now, not that I'm telling you to do that. I'm just saying that that's what I'm reading from Fidelity.
Yeah, right. And that's a great point, Shane. Every retirement account with Fidelity or with anybody else has an investment choice that is cash. It's a money market fund. Hopefully it pays a decent amount, but that is a completely viable alternative. And what they're pointing to is that, we've had 10 years of really solid gains for people that have been willing to take risk, and you've seen it. And
well, you're up 12% on the year on the Dow, 19 on NASDAQ, I think, and I don't know, since election day, you're like
pigs
50%
get fat,
up.
Hogs get slaughtered, right?
Yeah, you're 50% up.
And by selling and going and buying something else risky, you're not really making yourself safer.
No, you're not. Yeah.
As I point out, regularly on this show, by paying down your mortgage, even if it was at 4%, you're getting a guaranteed 4% after-tax return on your money. Especially now that the home interest deductions are not quite as juicy with the new tax code. So, there's places where you can reallocate your cash, pay down debt, get CDs or money market accounts over 2%. You can go through bankrate.com online. There's a lot of things still available out there. And the more people that think there's going to pullback happening, the less likely it is going to happen, right? I mean, it's still has legs to go up. There still is reason why this economy has growth in its crosshairs. We'll see if that, there's sectors that have been falling behind, right? Oil and gas is the obvious one to point to. Healthcare has had a terrible year. Small cap, Russell 2000 companies. I mean, there are less expensive places to take risk right now. We'll see. We'll see if the Walmarts and the Disneys can keep making it happen. In terms of, Shane's comments about Disney, I am a believer in the shift of power. I'm a believer in streaming going to basically the company with all the chips and all the money and all the resources. But one thing I want to caution is that with all these different players in there, there is competition, and Netflix will not go quietly into that good night. And so there will be price wars. There will be free stuff. And investing in stocks that are giving away free stuff and engaging in price wars is something to be careful of as well.
Yeah. Well, I know Hulu, I think.
Who?
Hulu, come on.
Who? Isn't that just a free service?
Well,
No,
it's
both.
both.
It's part of the Disney package.
Yeah,
You
it's
get
part of the Disney
ESPN,
package, yeah.
Oh,
you get
gotcha.
the Disney and Fox libraries, ESPN for sports, and Hulu for TV. So it's a huge package.
Yeah, I think Hulu might be extra. I'm not sure, but I think it is.
I wonder what my password is for that. I know I've got an account somewhere.
Well, no, I'm talking about it is extra, but if you buy a year,
Right.
Yeah.
and then it comes in the package. Yeah.
So who's really winning in that argument is actually the content makers right now. The people that can produce content and sell it to the highest bidder are the highest ones in demand, and I don't know where you'd invest in them, but that is.
Well, I think they've learned that from HBO and Cinemax and Showtime and all those that made their own content, like Game of Thrones and Dexter and all these various things that they produced, and Netflix, looks at that and say, well, House of Cards, and we'll make a bunch of stuff too. We'll make our own movies and get the same stars they get for Hollywood, and produce our own stuff, and we'll make the millions off of it because of more people are going to sit at home than are going to sit in a theater.
Jennifer Aniston was given an award on the E! Network the other day. I was watching it with my girls. I said, "Oh, girls, you got to watch this. You see this stuff." And she came on, and she looks pretty much the same, amazingly. And she did give kudos to Friends, her show. She's like, that made my career. And she said, it's still making my career.
Yeah.
Because that's what my girls
Friends,
watch all the
that's
time.
right.
And that's the royalties. Like, nobody ever thought that a show could make so much money over time.
8 or 9 years, and now it's going over to HBO, I guess, from Netflix, where it was.
Like 30 years ago or something.
Yeah.
It started. When
Yeah, well,
yeah.
and that, Netflix is at 283, and Disney's at 138. So with this addition of Disney Plus, clearly, if Disney were to get 100 to 200 million subscribers, you could see an interesting roar value on that one too.
Tough to do business when it's as fickle as just canceling your membership and moving on, right? Everybody loves the recurring revenue model, but it's fleeting as well.
Yeah. S&P 500 has performed far worse under Trump than under Obama. Very interesting. Well, Obama had the recession.
It helps when you start from zero.
When you start from zero, it's pretty easy to go up and perform better than you are right now. But I would say the records that S&P are doing didn't happen under Obama, certainly. So there you are. From our text line, 478-8298, what a surprise. Does Mike worry about U.S. debt growing? Should we be paying it down versus increasing it?
Well, that's a loaded question. Should you be paying debt down versus increasing it?
Of course you should be paying it down, but
our
it's still not a problem.
Right. And so there's lots of different ways you can measure it, lots of different ways you can get upset or comfortable with it. The U.S. of A. has got a lifetime of forever, hopefully, knock on wood. And so there is theoretically a percentage of GDP debt that we are comfortable and other countries think that we're comfortable and worth the credit of. I like to point out, okay, right now our debt is slightly larger than our annual GDP, maybe a lot more slightly than it used to be when we started doing this.
106%.
Okay, 106%. There's a lot of consumers out there that would love to be able to make enough money in a year to pay off all of their debt, and most can't. So it doesn't translate necessarily, but there's a lot of different ways to look at this. Is what is a sustainable credit limit for a person, for an entity, for a corporation, for a country? And you can do them. You can say, well, how many years if they took all their income, all of their productivity, and focused it on paying down their debt? How long would it take to pay it down? Right now, it would take 106% of a year for the U.S. of A. to pay all of it back. And of course, a large portion of the debt is moving it from one pocket to another pocket within its government entities.
I can say we own 70% or 60-some% of the debt, so it's
still a huge number.
Well, that's one reason it's not an issue,
right.
At least not to me anyway.
But it used to be a big issue with different parties over time.
Well, it used to be a big issue when the stock market wasn't as high as it is now.
Yeah, maybe. I mean, in comparison, that's another interesting thing is comparison to personal debt, because when the Great Recession happened, the government stepped in and took our debt off of our shoulders and burdened it on themselves. And so, how much of that is still terming off with the TARP and things. So, we're getting into deep esoteric economic things. The bottom line is always the credit of the U.S. of A. is solid until somebody out there doesn't think it is and starts selling dollars.
That's right. Well, what about Japan? Japan is our largest debt holder, are they not, Shane?
That's right, $1,174 million.
So what do you think of Japan?
I'm reading Shoe Dog, which is the story of Mr. Knight, founder of Nike, which has made he's made a lot of news lately. And he began by going over to Japan and getting shoes made over there and importing as a shoe importer. Yeah. And so it was a great look into back in the 70s, late 60s, the culture of Japan and how they were roaring. And I remember when their economy really got strong and hot, being in Southern California, you could see that in Hawaii. And then they stopped having babies, basically. And now they're dealing with a bunch of old people and low growth and still being stalwart economy, still in the game, despite not having a lot of upside. So I can't say I can really comment to where Japan stands in terms of bets, but they've always been there.
Well, we can tell them that they stand with a debt to GDP ratio of 238.20%. That's where they stand. So we'll be right back. I'd be more worried about Japan collapsing than I would the U.S.
That sounds like a canary.
We'll be right back. 26 minutes after the hour. It's Thursday, November 14, 2019, 29 degrees outside. Shane Montalban on the line. And, the other guy is in the is in the house too.
And we got the classic rock.
We got classic rock.
Tom Eaglehoff classic rock live band in the background.
That other one was supposed to be in there, but
you should have a live classic rock band in the background.
We should have a live classic rock band in here. Yeah, that should be
a house band.
That's right.
Yeah.
Turn this into the opposite of the late night show. This is the early morning show.
Yeah. Well, I don't know. Our text line people think we want to compare the Trump and Obama, but I can't do that because I don't believe presidents have anything to do. I don't think Barack Obama had anything to do with the recession, nor did Bush, nor did Trump. And so, it's not the Trump economy. It wasn't the Obama economy, and it wasn't the Bush economy. So there you are.
There we go.
Will the debt become bigger concern when interest rates go up, Mike?
Yes.
Okay.
Would you like more?
I'd like more.
Okay. A lot of the debt.
Listeners would like more.
Yeah. All right. So if you have a bond right now and it's paying you 2% and rates go up to 3%, you're going to wish that you had yours. You wish you had the 3%. But if the other way around, if you were borrowing money from people, it's going to get more expensive when it turns over and you have to reissue it. And so a lot of the U.S. debt isn't getting refunded when the term goes up. It's just getting reissued, and it's getting reissued at the new rates that would be more expensive.
What do we do? What do we do in the 80s when home loans were 15%?
I don't know. I was in high school then. Savings and loan crisis.
Right now, I'm looking around. We got the low unemployment. In the 80s, it was 10%.
Yeah.
And we had a 20% prime rate. And,
right, 18 to 20%.
10% inflation.
And right, we can imagine. We think it's our right as Americans to get a 4% 30-year fixed mortgage right now.
That's right.
And that, I think, is where our Achilles heel is, because housing, at least in this neighborhood and in some cities, is back to bubble levels.
But the point that I don't worry about the debt is because I lived through that and we made it just fine.
Yep.
It was tough going when it was going, but we made it just fine. All right, that's going to wrap it up for this half hour. Mike will stay with us. Shane will stay with us, and we'll be back to talk more about debt and money and bonds and markets and all kinds of stuff right after this. Stay tuned. 24 minutes before the top of the hour, 29 degrees outside. It's Thursday, November 14th, 2019. Mike McCormick Financial Advisors is in the house. And from our text line, Disney stock booms, great for kids. Same company that covered up for Epstein. Anything for a buck, I guess. That's from Pete. So, yeah. ABC, right?
His reference is that ABC is owned by Walt Disney. But Mike, so just as a hypothetical, when you're looking at the opportunity of making a change or a strategy to reposition yourself, and you see this kind of news around Disney and what they're doing with the 21st century streaming. Obviously, it's got a peak value at $138. As you know, it's trading at 18 times earnings. But is it a viable stock to look at as a strategy to maybe shift? If you say you're in a cable company of some kind and get out of it and into Disney, or do you look at that type of a shift that people should consider?
Sure. Yeah, great question, Shane. And when you're dealing with moving money in individual stocks, this I hope is your extra money these days. For the majority investors, using more of a diversified fund seems to have better success, certainly when emotional people are involved. But if you have extra money, if you are confident in how you trade, certainly moving away from buggy whip companies, as you called them earlier, is the best move you can do. And if you've been riding it out this long, you've already taken it on the chin. Let's think about a different version of this, Shane. Let's think about oil companies. Let's think about Exxon, which has just been a terrible performer for a while now, despite incredible asset base, incredible price to book, and a reasonable price to earnings ratio, and the fact that we have not reached peak oil consumption in anybody's estimate. Some people say in 1 decade we'll reach our peak oil consumption, and might be 2. So you're sitting on a company that if they don't pivot, if they don't evolve, they're going to end up like the cable companies, of today trying to charge $110 to deliver a lineup of Bonanza and Seinfeld reruns. Now, where do you go from here? Do you get onto a company like a Disney right now, which is smattering all over the news? There's a thing called a hype curve, which you can go review online, and I forget the tech wizard that came up with it. But the idea is that when a new idea happens, and Bitcoin's a perfect example of it, there's a big hype to it. And Disney's getting a lot of hype. They're getting a lot of demand. There's going to be a lot of people impulsively pulling the trigger on it. There's probably going to be in a short-term peak for something like a Disney that will end up going down. I mean, Disney's not going to be profitable right away on this. They're not going to post the numbers that they're profitable immediately. They're capturing market share. They're acquiring companies. They're rolling out new things. They're starting new divisions. They've got new hurdles and technology they got to deal with. And then over time, at some point, they'll have their act together, and they'll start realizing all the benefit. And that's the second part of this hype curve. This hype curve is like a short roller coaster up, down.
Yeah, they're a startup for all intents and purposes.
Then it's a slow kick up. So, yes, if you want to start putting a foot in the water, put a foot in the water. But do that so that it focuses your attention on paying attention to that company, how it's behaving in contrast to the rest of the economy. Is it tied to how all the other S&P 500 companies are doing, or is it doing its own thing? And then you'll be more sensitive and tuned to other times when you can say, it's doing something different today. It's got great valuation right now. Now's the time to move more money into it. Again, it's about getting over time, right? This is not going to be, today's not the day to go all in on Disney when it's on everybody's news and they just posted how many subscribers and how they're going to be the winner and Netflix is going down. I actually have a client that I know invests on his own some, and he's got a substantial portion in Netflix, and I sent him an email a little while ago that said, hey, you should start trimming your Netflix position over the next couple of months. It was not today. It was knowing that, Netflix still has a lot of subscribers. I'm still subscribing to Netflix despite all of this, right?
Yeah, me too. Yeah.
They will continue to be profitable for a period of time, and maybe they'll pull a rabbit out of the hat. But you do these things orderly. You don't all rush to the exit or the entrance with everybody else would be the gist of it. This Disney news is Disney's been a strong company throughout. Ever since they got SportsCenter together and realized that they don't need to pay actors to produce blockbuster movies. They've had things figured out pretty good.
Mike from our text line, 478-8298. Mike, what is the best time of year for the market to sell and what time to buy? Selling may go away in October, right? I think is what kind of a rule of thumb that's been around since 1929.
Right. And that it actually has not been true this summer. It was not true.
It wasn't. It wasn't
this summer.
This time around.
Last summer, I don't think it was either. So that one's getting to be trickier, probably because these hedge fund guys are now on the beach with their phones doing work and not truly disconnected. Now, the best time to plant a tree, yesterday. Best time to invest in the stocks, yesterday. That said, we are at one of those times where there will be tax loss selling going on. There will be repositioning going on year end. Typically, there's a period of time between now and about mid-December that I feel that can be soft based upon people repositioning. Sometimes when active funds have done well, they will be big sellers in the market because they don't want to risk underperforming. So if I'm managing the Washington Mutual Fund for Capital Group, which I'm not, and I feel like I've met my bogey, meaning I've kept my job and my bonus and my clients, I will reduce my risk right now, and that will put about a lot of selling pressure on the market. In fact, the opposite is happening. Most actively managed mutual funds are trailing the index, so they're unlikely to be sellers. But yeah, this would be the time of year right in here where there's a lot of repositioning going on. There's distributions being made, charitable gifts are being made. So there is generally a bit of a selling pressure happening this time of year. When to get back in, right afterwards. I just don't want people to be out of it. If you've got risk money, I don't want you to be out of the market.
All right.
At this point.
All right, we got to take a quick break, then we're going to come back and get Shane's thoughts on that very topic. So right after this, we'll be right back. Stay tuned. It is 13 minutes for the top of the hour. Shane Taubman on the line with me. Mike McCormick Financial Services in the house. And Shane, you have any thoughts on what we were talking about earlier?
One of the interesting aspects of ExxonMobil was that back 20 years ago, they invested $200 million in the development of algae fuel.
Mm-hmm.
Well, it's come around. It's turned into a significant opportunity. It's advancement. It's remarkable in what it is. So the Algae Business Organization survey of its membership for 2020 see the competitive fuel is on its way. It's a very light oil that's produced. It's clear. It's about a 52 weight, and the interesting aspect of it is right now it's the fuel's cost is about $5 or less per gallon, and the median price is around $4 per gallon. So 40% of the projected prices by 2020 is less than $3 a gallon. And the interesting thing, or the interesting aspect of this, isn't just for cars; it's also for planes. They project that wholesale prices in 2020 for jet fuel will drop from 123 per barrel or $2.94 per gallon to $1.54 per barrel or $3.69 per gallon, and diesel $163 per barrel to $3.89 per gallon. So now we have a viable replacement for oil. The problem is it's not easily scalable, and of course the second problem is it still has to be refined. But the discharge it creates is not as bad as carbon monoxide. So it's an interesting context and something I look for because I like to look for new innovation to talk to people about.
Mm-hmm.
All right. Let's take a phone call. 522-TALK is the number, 522-8255. Caller, you're on the Morning Soapbox with Mike McCormick, Tom and Shane. What's up?
Hey, good morning, guys. It's Kevin.
Morning, Kevin.
Hey, I got a question for you on oil. So you're talking about peak levels in 10 or 20 years. Does that mean peak supply and then we're going to start running out?
No, it has to do with consumption peak based upon shift away from fossil fuel burning. And the earliest estimates that I've heard have been 10 years, but more like 2030, 20 or 30 years out.
Okay.
Yeah, I like 2035.
But no, we'll have plenty of fossil fuel still in the ground. If that's,
that's what I was going to say. I was going to say every year they seem like they find a bigger and bigger supply of oil somewhere, and then with the shale, and then also the fact that it's a hydrocarbon which is reproducing. So, I mean, it's always going to be there because it's always going to reproduce. But what are they going to run jet airplanes on if they don't have jet fuel from hydrocarbons?
Absolutely. All great questions. And the theory, again, this is not my theory, the theory would be that we would just reach a crescendo of consumption. Maybe all vehicles would be shifted to natural gas or algae. But yeah, there'll be still things. And Shane's point was interesting because, again, jet fuel, you need to have a really heavy punch that I'm not sure if, anything but a hydrocarbon can pull off.
Mm-hmm.
So maybe the only use of oil is in plastics and jet fuels, which is still going to be significant. But right now we're still really increasing the number of people that are driving cars across the world for the first time. So we're still very much in a boom time for gasoline. Despite the few Teslas that we see driving around.
Well, the other thing you got to remember is the horse and the automobile coexisted on the farm and on the road for 50 years before tractors came in, and evolution replaces things.
You're not that old, Tom.
But yes, I am. I rode on the back of the horses that my dad plowed our field with. So, trust me, I'm that old.
I've got a great-grandfather younger than Tom.
Yeah, right. That's true. Everybody does. I only hang around with young people because there's nobody my age to fool around with.
If only we could learn how to bottle the hot air coming out of the Democrats in Washington, we might be able to fly jet airplanes on that stuff, too. All right, you guys.
All right, hey, thanks for the call.
Thanks for keeping us honest, Kevin.
The important thing about oil that I think everybody needs to be aware of is 80% of all the oil discovered is still in the ground.
All right.
Saudi Aramco going public. We didn't even get to that one. We'll have to push that one off till next week.
Yeah, we got to take another break. Unfortunately, it's a long one too, but we got to get it in. So we'll be right back right after this. We're back, and about 3 minutes left. So we've got a caller waiting on the line. Caller, you are on the air with Tom and Shane and Mike McCormick. What's up?
Good morning, gentlemen. This is Steve.
Hey.
So I wanted to pose a real quick question to Mike. I'm not going to get into the nitty-gritty, but in September, the U.S. Navy applied for a patent in the Patent Office of the U.S. for fission technology. So everybody knows fusion, well, maybe everybody doesn't. Fusion and fission, one is splitting an atom, one is creating an atom. Well, the U.S. Navy has patented the technology to do fusion, which is mating two elements together to create a new one. Extremely efficient, almost no residual pollutant. And this is real. This is very real. The patent's been filed. The Navy has the technology. This technology has the capacity within a 2-meter enclosure, so a 6-foot squared enclosure, to produce 2 gigawatts of power. I'm sorry, terawatts of power. It's unbelievable. It will completely decimate the fuel, oil, gas, energy production industries. So my question to Mike is, once this technology gets more mainstream attention, how does he think it'll disrupt all the energy markets?
Wow.
Okay.
Yeah, good stuff.
All right. Hey, thanks for the call. We'll have Mike answer.
Thank you, guys. I'll listen.
All right. Thank you. All right. Real quick, because you got about a minute and a half.
Space, the final frontier.
Yeah.
I mean,
before you do this, real quick, everybody go look up Star Technology Australia. It's done. They've already done this. It's coming, folks. You'll have a 4-inch cube in your home generating heat and light. The byproduct is oxygen.
Robert Downey did it in Iron Man 1, actually.
Yeah.
As well. Perpetual energy machines have been in the work and news flow for a long time. I've yet to see one. So I am skeptical. That said, whichever government comes out with a proprietary technology won't have to worry about their deficit for a very long time. And in terms of disruption, distribution networks are what is mainly keeping coal and fossil fuels dominant. Fossil fuels do include natural gas, which is clean burning, as one of the text commentators mentioned. I did my senior thesis just the other day at a college on natural gas vehicles. Very good technology. There's great technologies out there, including natural gas vehicles, that are not happening because of very real questions about distribution. Wind power in the Midwest is one of them. If we're able to generate 8.8 gigawatts Back to the Future style from a toaster, that's not going to happen anytime soon in my box.
All right. All right. Thanks, Mike, for being here. How they get a hold of you, son?
Interweb is alive and well, still pointing towards me, but I do like phone calls. No login needed, 522-3201. Thanks for all the text messages and calls. Just know that your stuff is getting read on the air, so keep participating. This is a great venue for our community. Thank you.
All right. And Shane and I will return with 5 things you need to know, and we'll catch up on the text messages and the app chat messages and all of that right after the news.
I got to put one more plug in. Go Hawks cross country on Saturday. They're going to the regionals. We got some athletes.